Hi, everyone. I hope you guys can see me and hear me. There's no live chat box today, so I hope everything is moving along. If it isn't, give me a thumbs up if you can hear me and the like button if you can hear us. So, as many of you have, this is me with my glasses and my brainstorming phase. Great. I saw another thumbs up. Keep giving those thumbs up if you can hear me because that's the only way I can see you. So, I hope you guys saw the disclaimer. That's our usual disclaimer. We had not planned on doing any videos for this month because I've told some of you in our community posts we're working on some projects. Sorry. And we hadn't planned any videos for this month. But given the conversations that are going on in the market at the moment and the FOMC meeting and the Fed's dovish comments, we felt it was important enough to do this. And that's why we're using this format. It was the quickest way to do it. So to sum it up for those of you that haven't seen it or heard it, which would have been hard basically to not see or hear about it, the Fed's forecast, their interest rates forecast is that essentially interest rates have peaked and they will come down very slowly from the current level. About, I think the median projection was 4.6, 4.75% roughly. What you've seen essentially is a free fall in rates on the bond market even before this announcement. So the purpose of this live is to basically try to explain what's happening and give you an update on where I feel yields are and what this means. Have yields peaked? And I have always said I don't have a crystal ball, and I wish I could tell you a better answer. The answer is I don't know, and neither does anyone else. So a lot of you have emailed about the fact that why are short-term yields still where they are, but long-term bond yields have gone down. And that is really the primary goal here, to explain to you how this works. So the Fed can set the short-term rates. And right now, the short-term rates at 5.25 and between 5.25 and 5.5. And that's where most of you see the rates with your short-term T-bill ladders. And when we say the Fed will lower rates, those are the rates that the Fed will lower. When we're talking about rate cuts down to 4.75, those are the rates. The Fed does not directly control the long-term rates. They can to some extent when they offload their balance sheet, but the market controls the long-term rates. And what we saw in October was that the markets, the bond vigilantes were essentially saying that the budget deficit was too high, so yields went up. And now we're looking at a different market where the Fed has said short-term rates have peaked. And what you're seeing in the market, in my view, is a lot of overselling at the moment. And in fact, an article just came out from Bloomberg today. We just received it about 20 minutes ago, where two of the Fed, I think it was two Fed officials, including the New York Fed president, essentially were trying to walk things back a little and essentially said, yes, they had said that rates had peaked, but they did not say to this extent. And so the market is essentially pricing in more cuts earlier than the Fed had targeted. So the market is currently pricing in the first rate cuts in March. I think Goldman has March, April, May, or April, May, June. I can't remember. But they're pricing it in very early, whereas for the Fed, in this article, they're saying it's closer to middle to end of the year. So what this means is that the T-bill rates, the short end rates that a lot of you are seeing, they're going to stay at around 5%. I think 5.5%. It was around 5.5%, 5.25%, 5.5% until the Fed announces their first rate cut. There may be a bit of movement beforehand if traders are betting, but for the most part, those will stay relatively stable. The long end is anybody's game at this point. And what you'll be hearing a lot and seeing a lot in the market at the moment is these two words that I've already seen in every second article today: a new paradigm, because Fed Governor Powell used them in his speech. New paradigm, just so you know, are fancy words for we don't know what's happening and everything is uncertain. And that's what you see. So if you look at the forecasts out there, as I said to our members last week in our live there, they're all over the place. So even within JP Morgan, and it's a big bank, I get it, right? It's a big bank. Even within JP Morgan, on the same day, there are two articles that are coming out where the chief investment officer is saying they don't see any rate cuts till the end of 2024. And then they have their co-head of US rates that says he sees middle of the year 10-year long-term bond yields at 4.75%, and by the end of 2024 at 3.75%. So there's a huge spread of where people are thinking things are going. I think I'm going to tell you what I said last week at our member live, which is essentially what all of us have seen since the beginning, since March 2022, when the Fed started raising rates, was that all the rates, they went up in a very linear path. And at some point, rates will go down in a linear path. Between the going up in a linear path and going down in a linear path, there is a lot of volatility as the market tries to figure things out, especially when there's a new paradigm, when the experts in the industry also cannot agree on a consensus. And I believe that we are at the beginning of this very volatile stage. So a question that I got today is, should we now panic and go in and buy everything? And what I want to tell you is our fundamental thinking has not changed. The budget deficit is still too high. The market is very volatile. Will you see, do I think, right? I could be wrong. I don't have a crystal ball. Do I think that the market is oversold? I've already said that I do. Do I think that it will go back up? And potentially a fair bit, maybe. But even if it does, they're very short blips. For those of you that have been watching the yields, even in October, when it went up to 5%, it was a very, very short time period. So our fundamental strategy to all of you is, if you know the maturities that you want to buy, dollar cost average into them. There's an auction every single month. In fact, I don't have the auctions. I have the auction schedule in front of me. The first auctions for the 3-year, 10-year, and 30-year are happening already on January 4th. So if you want a 3, a 10, or 20-year, buy a little bit at a time. Yes, it builds a bit of complexity in your portfolio because you have more bonds, but then you're not stuck with something at one bad auction. You're basically getting the average price over the course of the year, which will be a very, very volatile year. And you may catch it in a month when yields are high, or you may catch it in a month when yields are low. The problem with trying to time it at the moment is the times when they're really high are really so short. They're so brief. And by the time most folks get to them, most retail investors get to them, those yields are already gone. And if you're waiting for an auction, most likely they'll already be gone. So if you're trying to go long, my general advice, not knowing any of your situations, is what I would do if I was 60 or 70 or 80. I would go long by buying the maturities that I want on a regular basis. Or I would buy on the secondary market if I'm sitting by my machine, if I'm a trader, sitting by my machine and watching the yields every day. In terms of our personal portfolio, we haven't changed anything. So sorry, we have a member live after this where we're going to dive into more Q&As, but I wanted to do this to say, don't panic. This period of volatility is very, very normal when nobody in the market knows what's going on. And generally at the end of the year, the stock market does tend to rally. Generally, it happens after Christmas, but this time it seems to have happened way earlier. Don't panic. The message has not changed. There's a lot of noise. There will be more noise in the coming year. And it may my expectation is it will get even more volatile. So just to tame your mind and your heart, really the best thing you can do is to buy at every auction and get the average price over the course of the year. Because I can tell you, Fed officials have their dot plot, but their dot plot changes every quarter. In September, their dot plot showed that rates were going to be at 5.1%. Now it's 4.75. Who knows what's going to happen at this point? And if there's anybody that tells you out there that they know for certain that this is the direction it's going to go, I'd be a bit wary as well, because really nobody knows at the moment. Let me see if I covered everything. Oh, so the big question for a lot of us at the moment, the big question is, when will the yield curve invert, right? Because there's two ways it can go right now. Even if the Fed lowers, let's just say hypothetically speaking, and I'm sorry that I have no slides today. Like I said, we were not planning on doing this, so hopefully we will get back to slides in January. There's two ways this can happen, right? If assume the base case scenario, the Fed sticks to its dot plot, 4.75 in March, April, May, June, whatever it might be. Either the short end of the curve will go down or the long end of the curve will go up. And it's a battle in the market at the moment of which direction it will go. And nobody really knows when the yield curve will invert. Say that the Fed does lower to 4.75, their short-term rates, and you add, if it were to uninvert to go back to normal yield curve, the general premium on a 10-year over the short-term yields, it's anywhere between 50 basis points and 1%. So if you follow a normal historical average, you would get to a 10-year then roughly of 5.25 to 5.75. The thing is, we've waited all year for the yield curve to invert, and it has not inverted. So, this is, to sum it up, my strategy to you is, if you're older, the same advice that we gave, not knowing any of your situations, is if you know the maturities that you want, to start buying at every auction, or if you're comfortable with the secondary market and you see something you like, to do it that way. If you're on the younger end, you have time to quasi wait it out, like that's where we stand at the moment, then you can continue laddering at these short-term rates of 5.25. They're not going to change until we get closer to a rate cut. And it seems Fed officials now realize how sort of full of holiday cheer, let's say, Powell's speech was, because now they're trying to walk things back a little bit. And I do think the market is oversold. And I do think that there will be spikes up, and I think there will be spikes down. And I think there will be a lot of them in 2024. So just to keep your sanity, I think the best thing is, like we all do with the stock market, is to dollar cost average in. So I'm going to go now. And if you guys have comments, leave them in the chat box below. Come join our member live. We are going to be back in hopefully end of January when we finish our big projects. We'll have more announcements then. But if anything else comes up, if there's a major change in January, before we're ready to go back live with our regular videos, we will do something like this. Like I said, I didn't know I was doing this until my team was able to move a meeting this morning. So I hope this has helped some of you. And drop your comments below and we'll try to answer as many as we can. Okay. Well, I hope you guys have a great weekend and happy holidays. And we will see you all again in January, hopefully.